Hello, my friends. So if you got this video, you probably are interested in getting into multifamily investing and have some questions about it. And this is smart because we want you to be investing wisely. We want you to be making the right decisions and making sure that this is the best thing for you to do and that you're doing it from a place of understanding and some education. So I have my dear friend here and partner, Nitsan Mosery, the traveling investor, multifamily endgame master, who has been in the space here, this multifamily space for many, many, many years, who has created tons and tons of projects, successfully turned them from fruition to, from seed to fruition. So Nitan, thank you for your time and your expertise and sharing your most valuable asset, your time and your wisdom. So if someone was interested in getting into multifamily investing, what is that? What are some terms or things that they want to be looking for? And what are some ways that people could understand what it's all about?
Yeah, awesome, man. Well, thank you, Doug. I appreciate it. So when getting started in multifamily, right? The way it works is we go out and we put a property under contract. We find the right market to be in, and the right market looks like a market that has strong job growth, a lot of job growth. That's the holy grail. So when we find the market that we want to invest in, we build relationships with the brokers, and then we start analyzing the different properties that they're bringing to us, and we create what's called our pro forma. Our pro forma is our budget numbers, our financial model that we feel that with our expertise, with the market, the way in the direction that it's going, we'll be able to actually work on our business plan and create the value on the property, which will in turn, we'll be able to sell the asset, make distributions to our investors, and everybody will be a happy camper. Now, when you're investing in a multifamily syndication, okay, that's a new word. A multifamily syndication is where we bring on investors that don't have a say in the day-to-day management or operations of the property. Give me a second. I have a little buzzing sound going on over here. Okay. So a syndication, as I mentioned, it's where we go out there and we raise capital from our network, from our investor base, and they now invest in the multifamily asset. I'm sorry, my computer is going crazy here. So a syndication is where your investors come in, they invest, they are what's called a limited partner, an LP. A limited partner is just that. It's a partner that has a limited liability, meaning that if someone decides to sue the property or if the lender has action against the property, the investors have limited liability, which means that they are not liable for what goes on. It's the GP, the general partners, that have that liability thrown on them, the key principals, the sponsors, the guarantors. So an LP is someone who invests their capital into the project, into the opportunity, and they have a limited say in the day-to-day, and they have limited liability, hence LP, limited partnership. Right now, the GP is created by people like yourself, myself, that we're teaming up together, that we have the experience in managing a multifamily property. Now, when I say manage, we're not the ones actually talking to the tenants on a daily basis. We are managing the managers, right? We put in a third-party property management company in between us and the tenants, and then we step back and we manage the managers.
So from a perspective of liability, the LP has limited risk. Does it also impact the reward? Is there a different upside? Like, what kind of upside would a limited partner experience typically? Like, could you use an example of what that would look like if you have a property and we could use, I'm sure, a very round number to show how someone could be a limited partner and invest, what their exposure would be, what their risk and reward would be, and what would that look like?
Yeah, sure. Great question. So again, a limited partner has limited liability, meaning that if, God forbid, the property has to be foreclosed on, the lender is not going to go after the limited partners. The lender is going to go after the general partners, the guarantors, and also the debt is non-recourse. So there is no recourse back onto us, the general partnership. There's definitely no recourse on the limited partners. So, and an investor can be a sophisticated investor or an accredited investor, right? And these terms were created by the Securities and Exchange Commission. And the reason why we're dealing with the SEC is because when you're investing in a syndication, you're not taking ownership of the actual property itself. You're buying shares of the limited liability company that's taking ownership of the property. And that in itself gives us another layer of protection. So in that LLC that's taking ownership of the property, you have two classes, Class A and Class B members. The Class A members are the limited partners. Okay, then the Class B members are the general partners. And then you have the managing members who manage the GPs. So it's a whole breakdown of an org chart, and it looks pretty wild when you have it all broken down and on a piece of paper. So now, how does an LP make money? So an LP, an investor, will invest in their funds. We close on the deal, and every quarter we'll obviously do an analysis of the cash flow versus expenses, right? So we have expenses. You have the debt. You have insurance, real estate taxes, payroll, management fees, vendors, renovations, anything that is an expense, utilities, right? So we bring in the cash flow, subtract the expenses. Now we've got the net cash flow, and then that gets distributed between the limited partners and the general partners. Now, since every deal is different, the percentages of LP, GP can vary. Now, on a general basis, the split
Not
is
etched in stone. This is like,
right.
Here's a guideline.
Exactly. This is just, exactly a guideline. Usually the split is 70% of the cash flow, and the profit when we sell goes to the limited partners. They get the lion's share of the deal because they're investing their capital. Right? They're taking a lot of risk. Now, mind you, myself as the guarantor, I'm signing on a $5, $6, $7, $9 million loan. So I'm bringing that money into the deal itself. However, we're giving our limited partners the lion's share of the cash flow and of the equity. That's how we do business. We want them to enjoy, and we want repeat customers. So
could you break that down, like as an example, like as a deal, like as you're explaining, like what would be
sure.
So let's say kind of break it down, the numbers, go, oh, okay, cool, tangible.
Right. So let's say after expenses on a certain quarter, let me start again. Usually the way it works, so we split the cash flow 70-30, right? Let's just go with those numbers for now, okay? And what we like to say is usually that 70% will equate to a 7% return. So if somebody invests $100,000 in the project, on an annual basis, they should receive a minimum of 7% on their money. So that would be $7,000 annual that would get paid out on a quarterly distribution. Now, I can go deeper into the way the whole structure and the split works, but let's not complicate it and confuse people.
That when someone wants more information, we could do that. But let's just say, so if you're getting this, you and I spoke about getting involved, and I wanted you to understand what this sort of looks like. And if you want more information, then we'll get deeper and get granular and answer your specific questions so that you can have more certainty about the investment. But if you're like curious about it, this is giving you the 30,000-foot view.
Exactly. Now, let's say we sell the property after a couple of years and we profited after expenses, after paying back the mortgage, the debt to the lender, and paying all the expenses to the vendors and blah, 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 and whatnot. We're left with, let's say, $1 million. We split that $1 million. 70% of that goes to the limited partners. 30% will go to the general partners. Now, depending on what the return on investment is, how much the total investment was, that will determine the rate of return that the investor will receive. So through cash flow, they'll receive that 70% of cash flow, which should equate to what we dictate on our pro forma numbers, either 6%, 7%, 8%, whatever that is. Now, during the time that we're holding the property and we're increasing cash flow, a lot of times that 70% of the cash flow will increase as well. So that means that their rate of return, that 7% will go up as well, because 70% of 100,000 is one thing, but 70% of 150,000 is another rate of return, right? Mm-hmm. So as our cash flow goes up and that 70% goes up as well, their rate of return will go up from cash flow as well.
And would it be fair to say that part of your evaluation is ensuring that the properties have that room for rental increases? That part of your evaluation is, oh, these are already under market. We do a little work, and then we can now ask market, which will increase potentially 20 to 50% of the cash flow.
Correct. So when we sell, we pay off all the expenses. Whatever's left over, 70% goes back to the investors. Now, mind you, we pay off. The first thing that we do is when we sell a property is we give back. It's called the return of capital. We give back the initial invested capital to the investors. So now you've got your money back. Now from that, we're going to pay off all the expenses.
So the original debt that you were sharing is including the investor's investment.
Say that again.
So when you're paying back the loans, that is also including, when you say loans, it's not just a loan to a bank, it's also the loan that the investors put in. So
correct.
Yeah, just wanted to make that super clear.
Right.
That
You've got so we don't call the investors' money a loan because that was equity.
Right.
So that you have the debt from the mortgage, which is a loan.
Right.
We pay that back. We do a return of capital. So whatever the investors, let's say they invested $1 million, let's say we raised $1.5 million. So then we return the $1.5 million. We pay off the expenses, the vendors, and whatever is left to pay off. Then we take that cash flow, that profit, that equity, and we split it 70-30. Right. They get theirs, we get ours. We close the books, we close the LLC, we move on to the next deal.
Now, are there any tax benefits for an LP? What can how do they use that as an advantage?
So what we do when we buy a property, the first thing that we do is we hire a cost segregation company. It's an engineering company that does an engineering report on the property so that we can depreciate the value of the asset quicker. Usually, if you give your books to a normal CPA who's not really in tune with real estate and whatnot, they will depreciate the value of the property between 27 and 29 or 30 something years. And it's a long depreciation. What we do is we create this cost segregation report and we give it to our CPAs, and that accelerates the depreciation. So if something were to depreciate over 27 years, but its real life is only 5 years, we're going to depreciate over that 5 years and capture that depreciation. When we capture that depreciation, we give it to the CPA. They take the form, the report, they plug it in, they do what they do with their numbers and their formulas, and then they pass down that depreciation to our investors through their K1s. So if you have, now again, I'm not a CPA. You should talk to your CPA about this. Everybody's situation is different. But what we do is that depreciation can go against your passive income and lower your tax liability, which is awesome. So this past year, I did cost segregation on 1, 2, 3, 4, on 5 properties that I owned and bought, which means that these properties are going to have huge depreciation values, which is going to go against my passive income that I've gotten from my real estate. So what's been going on is the property's been appreciating, cash flow has been going up. We do the cost seg, we get the depreciation that can go against our profits to reduce our tax liability. It's the real estate trifecta.
And
It's
how long
awesome.
does the cost seg, does it only work for that first year, or does that also have a sunset in it? Can it be, because if we own the property for, like, how long is the average time? When's the event? Like, when someone gets into it, how long can they expect to be in this deal and then use those tax strategies?
So again, every deal is different.
Of
We
course.
usually set a time limit around 5 years, that it's a 5-year hold. But because of the markets that we go into, that there's such a strong market and they're on the upswing, usually what's been going on is in year 2, 3, 3.5, we'll start getting unsolicited offers and we'll sell the property. Now, the longer you hold it, the better off you are, because there's a recapture tax when you sell the property, right? But you still are able to make that depreciation value. You're able to withhold the cost seg is done for that year alone, for the year that you do it. Now, last year, in year 2022, that was the last year we were able to take 100% of the depreciation value. Our illustrious commander-in-chief decided to change that on us. And now this year, we're only going to be able to capture 80% of the depreciation. So if you're looking, if you know that this year you're going to have a lot of passive income, I highly suggest you invest in real estate, do the cost segregation, get that depreciation, because next year it's going to be 70%.
Wow. How do you know, how are they looking to wipe it out completely, or is
That's what Mr. Biden wants to do? Yes. He
okay?
wants to wipe out that cost seg as much as possible, and hopefully that he won't be able to, because that's going to really affect the real estate business and why people invest. Now, there's another way to save money on taxes and on capital gains, and that's what's called a 1031, a 1031 exchange. That's where you sell a property, you take that capital gain, you take all your profit, and you flip it into another deal of like kind at the same value or higher. And we just did this. I just did this with my Chilean group. We bought a property in San Antonio. It was 64 units for $5,065,000. We held it for 15 months, raised the rent, did the renovation, increased the NOI, and then 15 months later, we sold it for around $7,475,000. Now, if I were to give my investors that money, they would have had to pay tax on that capital gain.
Mm-hmm.
But what we did was we rolled all of that money into a $9 million Class A property. So for the same amount of investment that we raised for a $5 million property, we're able now to get into a $9 million property and not pay tax on that capital gain. And a cool thing to do also that we're allowed to do is in a year, year and a half, 2 years, once we force the appreciation on that property, we're able to refinance. The value of the property is higher. We'll be able to refinance, pull out more money, and give our investors back some, if not all, of their initial investment tax-free until we sell the property. So we'll be able to give them back part or all of their initial capital. So now they've got the money back, and they can go buy and we can go buy another property with that money.
So it is insane not to be considering multifamily as a strategy for long-term wealth, for tax strategies. And also there are opportunities for short-term gains, because when you do that, that experience, you could get your money back and still own that asset and then start another one while that's cash flowing. And then when the event happens on that property, you'll still get the 70% that you would have gotten in the first place, because all the investors and whatnot have been paid, reimbursed.
Absolutely, baby. That's the way to do it. That's the beauty of real estate. I was talking to somebody yesterday, and they were trying to convince me that NFTs, trading, auctioning, blah, 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 is the best thing. Since sliced bread. I'm going, how do you feel? Well, I'm making $2,000 a day, and blah. I said, that's wonderful. But is the NFT appreciating? Can you get cash flow from it? Can you 1031 it into another NFT when you sell it? Can you get bonus depreciation on it? I said, you can't do any of that. You can't do that with stocks, bonds, mutual funds, crypto, bonds. NFTs, nothing on this planet can give you what we just talked about except for real estate.
And then, thank you. And we'll just leave you this one thought, and then we'll wrap it up, because we want to honor everybody's time on this. Is based on, let's put a time stamp on this. This is 2022 or early 2022. Based on what's happening in the market and the economy, the odds are is that single family ownership is slowing. It's slowing right now, and people still need places to live. So the most stable and powerful investment opportunity in real estate is in the multifamily, because there are tons of people right now who are missing out on single family deals because they won't qualify. They change the interest rates, the LTV changes, all these things are changing. They still need to live somewhere. So if we could leverage our real estate through multifamily, we're going to be in a much more stable, much more powerful position moving forward. So with that being said,
absolutely.
thank you, Nitsan. If you have any questions at all, please reach out. Nitsan and I will very happily have a call with you if you have any other questions, and we have deals going on all the time. So please, let's keep the dialogue going.
Yes, absolutely. Yeah, thank you.
Cool. God bless.